Investing can be confusing. With so many options available, it's easy to feel overwhelmed and unsure of where to start. There are so many options. From individual stocks and bonds to mutual funds and more complex financial instruments, the choices can seem endless. Two popular choices are ETFs and ETPs. These investment vehicles have gained significant popularity among both novice and experienced investors. Both let you invest in a basket of assets. This means you can diversify your investments without having to buy each asset individually. This could be stocks, bonds, or commodities. By spreading your investments across different asset classes, you can reduce risk and potentially increase returns. They trade on stock exchanges, which makes them easy to buy and sell. This liquidity is one of the key advantages of ETFs and ETPs. Understanding the differences is important. Each has its own set of characteristics, benefits, and drawbacks. This will help you make smart investment choices. Knowing the specifics can guide you in selecting the right option for your financial goals. ETFs and ETPs have pros and cons. While they offer diversification and liquidity, they also come with their own set of risks and costs. We will discuss these in detail. By understanding both the advantages and disadvantages, you can make a more informed decision. This essay will break down the complexities. We will simplify the information to make it easier for you to understand. You will learn the key differences between ETFs and ETPs. This knowledge will empower you to choose the best investment strategy for your needs. You can then make informed decisions for your future. With the right information, you can confidently navigate the world of investing. Remember, knowledge is power when it comes to investing. The more you know, the better equipped you will be to make smart financial decisions. ETFs stand for exchange-traded funds. These are investment funds that are traded on stock exchanges, much like individual stocks. They are similar to mutual funds in that they pool together money from many investors to purchase a diversified portfolio of assets. However, unlike mutual funds, ETFs can be bought and sold throughout the trading day at market prices. They typically track a specific index, which means they aim to replicate the performance of a particular market index. This could be the S&P 500 or the Dow Jones Industrial Average, among others. ETPs stand for exchange-traded products. This is a broader category that includes ETFs as well as other types of investment products. They are a broader category that encompasses various types of investment vehicles. All ETFs are ETPs, but not all ETPs are ETFs. This distinction is important for investors to understand. The main difference lies in their structure and the types of underlying assets they hold. ETFs typically hold the actual underlying assets they aim to track, such as stocks or bonds. On the other hand, ETPs can also use derivatives. These derivatives are financial contracts whose value is derived from an underlying asset, such as a stock, bond, or commodity. Understanding these differences can help investors make more informed decisions. ETPs encompass a diverse range of investment products. The most well-known are ETFs, but there are also ETCs and ETNs. ETCs stand for exchange-traded commodities. They track the price of commodities. This could be gold, oil, or wheat. ETCs can provide diversification to your portfolio. ETNs stand for exchange-traded notes. They are debt securities. They track an underlying index, but they do not hold the physical assets. ETNs are riskier than ETFs. This is because they are unsecured debt. ETFs and ETPs offer several advantages. They are popular among investors for a reason. They are easy to trade just like individual stocks. They provide diversification, which helps spread risk across various assets. They can be more tax efficient than other investments, offering potential tax benefits that can enhance your returns over time. However, they also come with risks. It's important to understand that no investment is without potential downsides. ETFs that track volatile indexes can be risky. Market fluctuations can lead to significant losses if not managed properly. ETCs can be affected by supply and demand issues, which can impact their value. ETNs carry credit risk as they are unsecured debt notes. Before investing in any ETF or ETP, do your research. Understand the underlying assets. Consider the fees involved. Assess your risk tolerance carefully. Remember, investing involves risk, and it's crucial to be well informed. But by understanding the differences between ETFs and ETPs, you can make informed decisions. Knowledge is your best tool in navigating the investment landscape. You can work towards your financial goals with confidence and clarity, knowing you have made well-informed choices.